Welcome to Sectors Upclose. I'm Angeline Ong. Our focus today is on the FTSE 100 and our guest is Justin Urquhart Stewart, the director and co-founder of Regionally. Now, 2020 was most definitely not a good year for passive investors in the FTSE. The FTSE 100 lost around 14%, making it the worst performing international benchmark last year. So investors can be forgiven if they looked longingly across the Atlantic at the performance of the US's S&P 500. But unlike the tech-heavy US market, the FTSE is weighted heavily in more traditional economic plays such as global miners, oil majors, banks and drug makers. So now that commodity prices are surging and the global economy is on the mend, is now time to take another look at the FTSE, or are there other clouds on the horizon? Well, let's ask Regionally's Justin Urquhart Stewart. Justin, thank you so much for joining us. After its performance in 2020, what's your predictions on how the FTSE will perform this year?
Thank you. Well, I think it's going to be fascinating and going to be very different from last year. As you said, that tech-heavy indices in the States did really well as the tech sector was seen to be right in the sweet spot of the recovery. However, what we're now seeing, of course, is figures showing a really good economic recovery, probably 6% this year, maybe 7% in the States, and probably the year after. Globally, over 5 to 6% global recovery. This is very positive. And if this continues as continued growth and not just a short V-shaped recovery, then those old boring stocks in the FTSE 100s, the oil producers, the banks and the pharmaceutical companies, all of those ones which have been ignored to a great extent, are now going to see more demand coming through. And you're going to see that. And bear in mind, even if you had loyally sat there and watching the FTSE 100 going, well, it came back a bit, nothing particularly great. Remember that actually the yield you got from, and you compound that wealth over time, meant that still people were getting a good return on their investment, just not as exciting and not as profitable had you been in the tech sector.
Now, do you think the FTSE seems overly reliant on commodity plays?
The FTSE 100 goes by fashion fads over the years. We had utilities, we had a lot of the privatizations, we had the railway companies, all of those. Now we're in a position actually where it is to a great extent dominated by miners and financials and also with the pharmaceuticals. So these are the big companies and they tend to bully the market because the bigger the company, the greater emphasis they have, greater weighting they have within the index. So you can have a very good small company, with a reasonably small company in the FTSE 100 that does terribly well, has no impact on the index at all. So why I'm so positive of the index is the big companies, the big banks, the stronger banks, pharmaceuticals, those sort of ones coming through, and they'll now be beloved more with the miners, and that's when you'll see a FTSE 100 getting a more consistent rise. May not be as exciting as the Nasdaq, but remember, rule one of investing is don't lose it. Number two, refer to rule one.
Now, Britain also left the EU in the middle of this pandemic mess. Some say that it was a good time to buy up battered down stocks. Others say it's still too risky to jump in right now. What's your take on that?
Well, I think Brexit is beginning now to show the difficulties in terms of whether it's the amount of people able to be employed. We have a shortage of people to be employed in this country now, and concern over the amount of trade. And of course, we have the Northern Irish issue as well, all of that. And that affects the one key word for the economy, and that, of course, is confidence. They need to be able to resolve the Brexit issues and be able to be more flexible and encourage more labour, particularly in the leisure and also agricultural areas, because we're seeing a big impact now on those areas because they cannot get enough people coming in. It's not so much you won't get served at the bar, it's just going to get served later and get thirstier.
So, Justin, you're clearly a fan of the FTSE 100, but how do you think it stands relative to other investment opportunities which offer more growth?
Well, to a great extent, the FTSE 100 can be seen as being quite dull because it's not a British index, it's a global index to a great extent. And also it is fairly broadly spread amongst generally value stocks. It's not the exciting growth areas. So it's not something where you'd be putting all your pension money into, but it forms to me a core part of people's portfolios, particularly if you're based in the United Kingdom or in a sterling area. But you then add to that other asset classes, but also other geographical areas. We can see where the good growth is coming. As we see the next stage of the economic recovery around the world, watch Southeast Asia and the emerging markets starting to gather a bit more momentum, basically, but also backed by those rising commodity prices.
Thank you very much. That was Justin Urquhart Stewart, the director and co-founder of Regionally. Before I go, here are some of the top stories in the UK investment arena. Telecoms billionaire Patrick Drahi has taken a 12% stake in the UK's BT Group for around $3.1 billion, becoming its largest shareholder through a newly formed holding company, Altice UK. Altice says it has informed the board that it does not intend to make a takeover offer for BT, although analysts say it may pressure BT to spin off some of its assets. Online trading group CMC Markets set out plans to launch a wealth management platform after reporting a doubling of annual profits. CMC is riding a wave of retail trading. Its profit rose to $315 million on a surge in clients trading complex financial instruments called CFDs. CMC did not disclose further details of its new wealth platform. And Britain and the European Union failed on Wednesday to agree any solutions to solving a row over post-Brexit trade with Northern Ireland that will likely cloud the G7 summit. British media have called it the sausage war as it affects the movement of chilled meats from Britain to the UK province of Northern Ireland. On Wednesday, the dispute moved up a gear, with Britain unilaterally extending a grace period waiving customs checks on food shipped to the province. The EU responded with threats of legal action. US President Joe Biden is widely expected to press the UK to respect the Brexit trade deal in order to protect the 23-year-old Good Friday Agreement. And that's your look at the FTSE 100. I'm Angeline Ong, and this is Reuters.